Okay, let's unpack this. Think about the last significant trip you planned. The last time you booked a hotel room, searched for a flight, or maybe even tried to get a tough restaurant reservation while you were away. There is a very high probability that the company you were interacting with, the one processing that transaction, was actually Booking Holdings.
Yeah.
It's not always the name you type into your browser, right?
hmm
But it's this massive engine, this quiet giant working behind a lot of the global travel industry.
Right. You might be on Booking.com or Priceline or Agoda, maybe even Kayak. But at the corporate level, at the very top, it's the holding company that's coordinating that whole enterprise. And you'd probably never even know its name.
It was truly fascinating here. What we're going to dive into is just the sheer scale and the strategic complexity of this organization.
It's immense. Booking Holdings, Inc., or BKNG as it trades on the market, isn't just a big company. It's an American travel technology conglomerate. It's incorporated under Delaware law, headquartered out in Norwalk, Connecticut. We are talking about an entity that has achieved really global dominance.
Absolutely. And that transformation is why we're doing this deep dive. The operational scale is just staggering. The company has platforms in about 40 languages, and it reaches across something like 200 countries and territories.
Yeah, that's right.
And to put its economic size into perspective for you, it ranks 243rd on the Fortune 500 list. So our mission today is to really look at the profile of its history, its financials, its acquisitions, and understand how a business that started with this quirky, domestic bidding model.
Name your own price thing.
Exactly, that one. How it transformed into this massive index-listed travel tech superpower. It's a component of the NASDAQ 100, the S&P 100, and the S&P 500.
And, to connect that scale to the strategy right away, its core identity is key. When a company gets included in indices like the S&P 500, it's a signal. It signals long-term stability, a huge market cap, and that makes it really attractive for big institutional investors.
Of course.
And Booking Holdings, fundamentally, is a holding company that controls the entire user journey. They own the meta search engines where you start planning, the booking platforms where you buy, and even some of the software that hotels use to run their businesses. It's a complete end-to-end ecosystem.
That's what makes this a masterclass in corporate strategy, not just a history lesson. It's not one platform. It's this strategically coordinated family of brands. But to really appreciate where they are now, we have to go back to the late 90s when they were anything but stable. The story starts back in 1996, Stamford, Connecticut. And it really centers on the founder, a guy named J.S. Walker. His initial concept for Priceline.com was genuinely revolutionary for its time. It exploited this fundamental inefficiency in the travel market.
It was brilliant in its simplicity, really. The genesis of this whole empire was Priceline.com, and it launched with this heavily advertised name-your-own-price bidding model. This was completely different from the fixed-price models that, travel agencies or other early websites were using.
So you, the customer, would basically say what you were willing to pay for a flight or a hotel.
Exactly. And Priceline would then try to match your bid with inventory that vendors wanted to sell, often at a steep discount. The catch was you had to be flexible on the exact flight times or maybe the specific hotel brand.
And the key concept there is perishable. That's the magic word. This system worked because it was perfect for vendors holding inventory that was about to expire and become completely worthless.
100%. An empty airline seat once the gate closes or an unbooked hotel room after midnight, that represents a total loss of revenue. That inventory is perishable. Walker's model gave airlines and hotels this discreet, last-minute way to liquidate that inventory without publicly slashing their prices and devaluing their brand.
Right, the whole opaque nature of it. You knew the neighborhood, but not the exact hotel until you paid. That was essential to keeping that brand separation intact.
It was.
And this novelty, combined with that late 90s tech bubble euphoria, it just led to this incredible, almost immediate financial explosion.
Well, it was the definition of an IPO windfall. The company went public on March 30th, 1999, under the ticker PCLN. The public response was just meteoric. Analysts at the time saw it as the perfect example of the era's hunger for these new, disruptive internet business models.
And Walker himself did pretty well out of it.
To say the least. J.S. Walker, he held a 35% stake in the company. He became a multi-billionaire literally overnight based on that initial public valuation. This wasn't just a success, it was the market saying it believed this bidding algorithm was a powerful, transferable idea.
And this is where the story takes a sharp turn, maybe towards a bit of hubris. It's a crucial lesson about keeping a successful idea in its proper context. The company seems almost intoxicated by this belief that if name your own price worked for perishable travel, well, it could work for everything.
And that assumption, that turned out to be the Achilles heel of the whole initial concept. Right after the IPO, Priceline went on this very aggressive experimental tangent. They tried to diversify into completely non-travel markets, trying to replicate the formula where that core principle of perishability it just didn't apply.
Give us the list of these failed experiments because looking back, it really highlights the kind of reckless diversification that was happening during the dot-com bubble.
Oh, it's quite a list. They launched these high-profile attempts to use the bidding model for totally different things. They had offerings for groceries, for gasoline, home mortgages, even new and used cars.
Cars and gasoline, how does that even work?
Well, it doesn't. Think about it. You're applying an opaque bidding system designed for a fleeting service, like a hotel stay, to a physical commodity like a gallon of gas or a bag of groceries. The supply and demand, the lack of a central clearinghouse, and crucially, the lack of that true perishable loss factor. It meant the model just failed. It couldn't generate the same cost savings for vendors.
And the market did not wait around to see if they could figure it out.
No, it was brutally swift. All of those non-travel offerings, the groceries, the gasoline, mortgages, cars, they were launched, tested, and completely shut down within a single year. The year 2000.
Wow.
This quick and very expensive failure taught them a critical, almost fatal lesson. The name-your-own-price model was entirely dependent on the specific economics of travel inventory.
You can't bid for a gallon of gas the same way you bid for an empty hotel room that's about to become worthless. So once the dust settled from the IPO high, the dot-com crash, and that diversification disaster, they were left with just their core travel business.
Yeah.
They had to find a real sustainable financial model that wasn't just based on one, potentially limited gimmick. What did they land on?
They pivoted to the business model that defines them today, and this is absolutely critical for understanding their later success. Their primary source of revenue became commissions. They act as a broker, right? They facilitate a transaction between the service provider, the hotel or airline, and you, the consumer. And for that, they take a set percentage.
And that commission model, it fundamentally changes their risk profile compared to an inventory model.
Completely. It removes all inventory risk. Priceline doesn't own the hotel rooms or the airline seats. They just provide the technology platform for the exchange to happen.
It's an asset-light model?
Very asset-light, which means their fixed costs are relatively low compared to the volume of transactions they handle. A smaller but still important part of their revenue comes from advertising things like sponsored listings on their sites. This shift to an asset-light, commission-based, sort of cash register model is what let them survive the market downturns that followed and really set the stage for their next phase, global domination.
It's really the difference between being the shop owner who has to worry about his product spoiling and being the company that builds the indestructible network of credit card machines that every single shop owner has to use.
That's a great analogy.
And that realization that infrastructure and reach were more valuable than a quirky pricing model is what led to their great strategic pivot.
And this next segment really is the inflection point for the company. It's what transforms it from a volatile US-centric .com into a global tech superpower. The big strategic turning point was realizing that growth wasn't going to come from forcing the name-your-own-price model on the rest of the world. Instead, they shifted focus entirely to aggressive international acquisition, starting around the mid-2000s. The goal changed from controlling how you booked to controlling how much global inventory they had access to.
That philosophical shift is so important. It's why Priceline survived when so many of its peers didn't, and they immediately saw their biggest weakness, Europe.
They executed a textbook acquisition masterclass. They focused on Europe, and they used a standard, scalable, commission-based model that was already working there. The key deals that laid this groundwork happened very quickly in 2004 and 2005.
So walk us through those foundational purchases.
Okay, so the first major move was in September 2004. They bought ActiveHotels.com. This was a European online hotel reservation company, and they paid $161 million for it. This immediately gave them operational infrastructure and, crucially, relationships with hotels all across the continent. Active Hotels was already using the agency model, that commission structure, very successfully.
And then, not even a year later, came the acquisition that really defines the entire company today.
That's the one. The defining moment was acquiring Booking.com in July of 2005 for a purchase price of just $133 million.
Let's just pause on that number for a second. $133 million
Right.
for the company that is now the namesake and flagship brand of a corporation worth, what, tens and tens of billions of dollars?
It's one of the most brilliant capital allocation decisions in modern tech history, without a doubt.
So what was the immediate strategy when they bought Booking.com? And why did it work so well in Europe when the Priceline model hadn't?
Well, the sources note that they immediately merged ActiveHotels.com and Booking.com. This created a huge synergy. Booking.com had the superior technology, a really great user interface, and a strong base in the Netherlands and nearby. Active Hotels had the broader market access and supplier contracts.
So they combined the tech with the network.
Exactly, the best of both worlds. And crucially, the European market just preferred a transparent, direct model. They wanted to see the price and the property up front, not this opaque bidding thing. So the commission-based direct booking platform was instantly scalable and really globally exportable. That $133 million investment became the anchor of their entire global identity.
It's such a powerful example of recognizing international market potential and then being willing to shift your whole corporate strategy to match a successful acquired model instead of forcing your domestic one abroad.
Right.
And once that European foundation was set, they started to systematically build out their control, both geographically and vertically.
They really did. They followed a very clear strategy of buying specialized brands to fill any gaps they had. In 2007, they acquired Agoda.com. This was strategic because Agoda was focused on the Asian market, which is incredibly complex, fast-growing, and diverse. Booking patterns, payment systems, supplier relationships in Asia are just fundamentally different. Agoda gave them that local expertise.
And then they moved beyond just rooms into other critical parts of the travel experience.
Precisely. In 2010, they bought a company called Travel Jigsaw, which they later rebranded as rentalcars.com. This built out their non-accommodation inventory. It was a huge step toward true vertical integration.
Their goal was becoming pretty clear.
Oh, yeah. Capture the customer at every point of their trip, the flight, the car, the hotel, and take a little commission slice from each one.
But the next huge acquisition wasn't about inventory at all. It was about data, about controlling traffic, and really dominating the very start of the customer's journey. And that brings us to Kayak.com in 2013.
Kayak was a statement acquisition. It cost them $1.8 billion. And to understand the strategy here, you have to understand what Kayak actually is. It's a meta search engine. So unlike Booking.com or Priceline, where you actually complete the booking, Kayak searches hundreds of other travel sites, including their direct competitors like Expedia, and it just points you to the best deal it finds.
That seems counterintuitive for a company that makes its money on commissions. Why spend almost $2 billion on a website that might just send your customer to a competitor?
It's all about control. Control over the information flow and, most importantly, data acquisition. By owning that first step in the search process, the meta search, Booking Holdings, gets massive insight into what customers want, what they're willing to pay, and what competitors are offering.
So Kayak still operates independently.
It has to. It maintains that objective appearance to the consumer, which is vital for trust. But behind the scenes, it functions as this incredibly powerful data funnel, directing huge amounts of high-intent traffic back into the broader Booking Holdings ecosystem. Even if it just earns a small referral fee sometimes instead of a full commission, controlling the top of that sales funnel is often worth more than just the final transaction.
That internal tension between their transactional sites and their meta search sites is fascinating. We should come back to that. But 2014 showed they weren't just thinking about travel logistics anymore. They were thinking about the whole hospitality experience and the technology underneath it.
That year was a major diversification. The biggest deal, of course, was OpenTable, acquired for a massive $2.6 billion. This wasn't about selling hotel rooms. This was about buying the market leader in consumer dining reservations.
What was the strategic thinking there? It's a huge investment outside of their core business.
There are a few key reasons. First, OpenTable's users overlap heavily with high-margin customers, especially business travelers who expense their meals and high-end leisure travelers. Second, it's a huge data play. Knowing the dining behavior of a traveler is incredibly valuable when you're trying to sell them travel packages or target ads.
And third,
it established their presence in software as a service, or SaaS, for restaurants. It showed they could scale their tech infrastructure beyond just hotels.
And they doubled down on that tech side, moving into the essential but maybe less glamorous B2B software market that same year.
Yes, and this is critical and often overlooked when you talk about their power. In 2014, they also acquired Boutique and Hotel Ninjas for about $98 million combined. These were not consumer brands. They provided software for hotels, specifically property management systems or PMS tools and digital marketing services.
What does controlling the PMS software actually give them that owning Booking.com doesn't?
It embeds them much deeper into the hotel's own infrastructure. The PMS is the digital backbone of a hotel. It handles check-ins, inventory, pricing, billing, everything. By owning or integrating tightly with the software that controls a hotel's operations, Booking Holdings gets better data flow, real-time inventory access, and it makes it harder for their competitors to get that same level of access.
So while Booking.com is capturing the customer,
These B2B acquisitions are managing the plumbing. It ensures their competitors face more friction. It's a much more sophisticated strategy than just selling rooms.
if you look at that whole trajectory from 1996 to 2014, it's just this astonishing arc from a risky startup gimmick to a fully integrated global tech infrastructure provider. It's no wonder they needed a new corporate identity.
That's right. That realization that they were no longer a bidding company, but a global infrastructure group, brings us right to the evolution of their corporate name. The original name, Priceline, just didn't fit anymore.
Right. By the mid-2010s, the parent company was still technically called Priceline.Com. Incorporated, even though the engine of their growth, Booking.com, had just completely eclipsed the original brand in terms of, global reach, revenue, everything. It created this real identity crisis at the corporate level.
And so the first change came in April 2014, recognizing that dissonance. They switched from the very specific Priceline.com Incorporated to the more general The Priceline Group, Inc. This acknowledged that they were a portfolio of brands, but it was still tied to that old PCLN ticker and the original name.
But the final, definitive change, that really signaled the ultimate success of their acquisition strategy, didn't it?
Absolutely. In February 2018, they made the big shift. The company name changed to Booking Holdings. And crucially, the stock ticker switched from PCLN to BKNG.
Yeah.
This was a huge market-facing corporate statement, it said. The brand we acquired, Booking.com, is now our corporate identity.
Because that's where the money was.
That's where the money was. It represented the majority of their revenue, their global footprint, and their future. It just highlights the staggering return on that $133 million deal from 2005. The strategy was clear. Align the corporate name with the brand that has the most global recognition.
Okay, so moving from the brand to the people, the leadership history is surprisingly eventful for such a financially steady, tech-driven company.
It really is. It's a fascinating case study in corporate continuity and governance. You had Jeffrey H. Boyd, who was the long-serving CEO from 2002 to 2013. He was there during that critical period when they made the pivot to global acquisitions, buying Booking.com and starting that massive expansion. He really established the successful template.
But his successor, Darren Houston, had a much shorter and much more controversial time at the top.
He did. Darren Houston was named CEO in January 2014. His time in charge, however, ended very abruptly in April of 2016. He was forced to resign, and it was because of an undisclosed personal relationship he had with an employee.
Wow.
Yeah. In an organization so focused on scale and tech, this incident just shows that corporate governance and codes of conduct are still critical factors that can disrupt even the biggest companies. The board moved very quickly to stabilize things, bringing Boyd back as an interim CEO.
And what does the speed of that resignation tell us about the priorities for a public company of this size?
It just underscores the intense scrutiny on C-suite leadership. The board clearly prioritized stability and compliance. The resignation was a necessary move to protect the brand and shareholder confidence. It proved that having an experienced hand like Boyd's available was essential to bridge that crisis.
So who ultimately took over permanently to guide them through the next phase?
That would be Glenn D. Fogel. He was named CEO and president effective January 2017. Fogel is the current leader. He's the one who successfully navigated the pandemic and has really focused on cementing the company's vertical dominance. We see that reflected in their more recent late-stage acquisitions.
And speaking of that, their recent moves show they are still aggressively filling these very specific niche market gaps long after the main business model was set in stone.
The pace just remained relentless. From 2017 on, they really shifted focus to strengthening metasearch and securing unique experiences inventory. So in 2017, they spent $550 million to acquire Momondo and Cheap Flights. This was a clear move to bolster their control over that initial customer search funnel, just like the Kayak strategy, to make sure fewer customers start their journey on a competitor's platform.
They also made a big move into tours and activities, which is a growing high-margin part of the travel industry.
Right, that's where Fairhober comes in. They bought it in 2018 for $250 million. Fair Harbor is all about the things to do, market tours, activities, local experiences. Integrating this means a customer can now book their flight, their hotel, their car, and now their sightseeing tours all within the Booking Holdings ecosystem. It just increases the total transaction value per customer.
And they shored up metasearch again in 2018.
They did, with hotels combined, for $140 million.
And then came the most geopolitically significant move of that period, which involved a huge investment in China.
Yes, the 2018 investment in Didi, China's dominant ride-hailing and local services platform. Booking Holdings took a significant minority stake for $500 million. This partnership was crucial. Instead of trying to build their own ride-hailing service in China, they just bought the integration. This lets them seamlessly offer local transport for international travelers in Asia, linking your hotel directly with local mobility. It minimizes friction for the customer in a very complex market.
And finally, the 2022 acquisition of Getaroom suggests they're focused on even broader distribution networks now.
Getaroom, which they bought for $1.2 billion, seems to be aimed squarely at expanding partnerships. So think wholesale travel providers, large affiliate networks, B2B volumes. It's about making sure Booking Holdings isn't just capturing direct consumer traffic, but also these massive behind-the-scenes booking volumes that flow through less obvious channels. Every path to booking a room should lead back to a BKNG platform.
But it's important to note that even a player this dominant faces regulatory hurdles. They can't just buy everything.
Absolutely. The source material highlights that the company's offer to acquire a company called GoToGate was actually blocked by European regulators. This is the reality for a market leader. As you get bigger and more dominant, competition bodies, especially in the EU, pay very close attention. A block like this is a signal that regulators see Booking's dominant position and are willing to step in when they feel consolidation threatens market competition. That scrutiny is a constant factor in their modern strategy.
It's a fascinating arc. From trying to disrupt the market with a pricing model to trying to acquire every major piece of the market, which then triggers anti-monopoly alarms. All right, let's see what all that successful consolidation looks like in pure financial terms.
Well, if the acquisitions tell the story of their strategic brilliance, the financial data really provides the hard evidence of that success. It charts this relentless upward march that was, as we'll see, severely stress-tested by a huge global shock.
Okay, so we're looking at 9 years of data from 2016 to 2024. The overall revenue growth is just a testament to how effective their strategy was.
Yeah.
In 2016, revenue was, what, $10.7 billion?
That's right.
By 2019, it climbed to $15 billion. And by 2024, revenue hit a massive $23.74 billion. That's more than doubling your top-line revenue in less than a decade.
And that sustained climb just highlights the core strength of that commission model. They can absorb new acquisitions and scale up the transaction volume so efficiently. Their net profit figures follow a similar, very healthy trend. It was $2.1 billion in 2016, rising to $4.8 billion by 2019. This shows not just growth, but increasing efficiency. They were converting more of that revenue into pure profit.
But then we hit the anomaly. We hit 2020. This period was the ultimate unforeseen stress test for the entire global travel industry, and the numbers for Booking Holdings are they're incredibly dramatic.
Analyzing 2020 is probably the most instructive financial lesson here. As global travel just ground to a halt because of the pandemic, their revenue plummeted. It went from $15 billion in 2019 down to just $6.7 billion in 2020.
That's a collapse of 55% of their revenue base in 1 year.
It is. And the net profit figure is even more striking. It dropped from a very substantial $4.8 billion in profit in 2019 to just $0.06 billion. That's only $60 million in 2020.
Wow. Going from almost $5 billion in profit to barely breaking even. That's a stunning collapse. And yet, like you said, they did break even. They stayed in the black. They avoided a net loss for the year. What structural advantage in their model allowed them to weather that catastrophe without massive losses, unlike, say, the airlines or hotel chains who own all their assets?
That right there is the ultimate sign of resilience that the asset-light commission structure provides. Because they don't own the physical assets, the hotels or the planes, their biggest costs are tech infrastructure, marketing, and people. When bookings stopped, their variable costs, especially commissions and marketing spend, they dropped almost instantly and proportionally. They could cut costs rapidly while keeping their core tech running. They didn't hemorrhage cash, and they were ready for the immediate rebound. That $60 million profit is the financial proof of their business model's stability.
And the recovery has been just as remarkable, showing how essential travel is and just how strong their market position is.
It's a classic V-shaped recovery. By 2022, revenue was back up to $17 billion, already surpassing 2019 levels. The 2024 figures are stunning. Revenue at $23.74 billion and, crucially, net income of $5.882 billion.
So not only did they recover, they significantly surpassed their pre-pandemic peak profit of $4.8 billion.
Exactly. It signals accelerated growth and market consolidation after the shock, as smaller, less resilient competitors just couldn't keep up.
And we can see the growth beyond the income statement, too,
Yeah.
in the balance sheet metrics.
Total assets grew consistently from about $19.8 billion in 2016 to $27.71 billion in 2024. This reflects ongoing investment in tech, those strategic acquisitions like Getaroom, and just having robust cash reserves. Employee growth also tracked this expansion, going from 18,500 employees in 2016 to 24,300 in 2024. It proves that even with these sophisticated platforms, you still need a growing human workforce to manage a global conglomerate like this.
But to put this scale into truly relatable terms for you, the listener, let's look at the sheer volume of activity they handled in just 1 year, 2023. This moves it from abstract billions to actual human movement.
This is where you really grasp their market penetration. The 2023 booking volume data is just immense. In accommodation alone, consumers booked 1,049 million room nights using websites owned by Booking Holdings.
1,049 million.
That's over 1 billion room nights processed in a single year.
1 billion nights. That is a stunning concentration of market power. What are the other verticals?
In mobility, their platforms process 74 million rental car days. And for air travel, they booked 36 million airplane tickets through their various platforms like Kayak and Priceline.
So when we combine that billion room nights with their financial resilience and that sophisticated acquisition strategy, what's the core takeaway for their market position today?
It means Booking Holdings isn't just a participant in the global travel market. It is arguably the dominant, unavoidable clearinghouse for accommodation. Processing over 1 billion nights a year shows they hold immense leverage over tourism and business travel. That scale lets them negotiate better commission rates, attract more inventory, and really dictate the terms for both consumers and suppliers. They've solidified their position as the essential, quiet infrastructure of travel tech.
It's the perfect illustration of how effective that pivot was, moving from a domestic brand-dependent gimmick in the 90s to becoming this global, resilient, infrastructure-level utility that just facilitates transactions at an unmatched scale. So let's try to consolidate the 3 most important takeaways from this deep dive into Booking Holdings for you. First, I think, is the incredible power of strategic acquisition over just organic growth. The entire foundation of the modern company, Booking.com, was bought for less than $150 million, a pittance that became the multi-billion-dollar company's namesake.
Secondly, we learned the absolute necessity of evolving beyond a single defining gimmick. That name-your-own-price model, while it was great for their IPO, was just too limiting. It wasn't scalable globally. The company only achieved dominance by pivoting to the robust, asset-light, commission-based model that Booking.com already had.
And finally, that massive financial resilience we saw during the 2020 anomaly. The fact that the company turned a profit during the complete collapse of travel and then saw its 2024 net income blow past its pre-pandemic records, it just demonstrates the structural stability and long-term dominance of their diversified portfolio.
And this brings us back to that inherent tension we mentioned earlier, which is the final provocative thought we want to leave you with. Booking Holdings, as we know, makes its money primarily from commissions. But remember, this one corporate family owns both the transactional, commission-heavy brands like Booking.com and Priceline, and the objective meta-search engines like Kayak and Momondo, which are designed to show you competitor prices. So the question for you to think about is, does the parent company ultimately benefit more from directing you toward its own booking sites, where it captures the maximum profit, or toward the meta-search sites that maintain your trust by showing the absolute best deal, even if that deal is on a competitor site? Because Booking Holdings controls so many different points of contact, from your first search to your final payment, you have to consider how that flow of information is subtly optimized and managed within a single corporate family that controls the entire travel ecosystem. That subtle tension between impartiality and profitability is where the real complexity of the modern travel market lies.